So the first of our problems here we're going to look at for Chapter 13, Financial Performance Measurement, is problem SE2 on page 617, where we're looking at understanding the sources of information that we would use in various different scenarios. So the problem reads, for each piece of information in the list that follows, indicate whether the best what would be the best source of information would be. A, reports published by the company. B, SEC reports. C, business periodicals. Or D, credit and investment advisory services. So the first problem is the current market value of a company's stock. Where would be the best place to find information about the current market value of the company's stock? And that, in this particular case, would be C. And that would be business periodicals. So for instance, we might find that in the Wall Street Journal, or we might find information online on an MSN Finance or Yahoo Finance. Second question, management's analysis of past year's operations. Where would we find that? And logically speaking, we would find that in A, reports published by the company. Number 3, objective assessment of a company's financial performance. Where would we be finding objective assessment? Assessment meaning analysis. And that would be from our credit and investment advisory services. D, they're the outside analysts that are separately assessing our company's financial performance and providing oftentimes a rating on that particular company. Question number 4, most complete body of financial disclosure information. And that would be the Securities and Exchange Commission. B, this is the basically governing body for all corporations that issue public stock, and so therefore they would provide a complete source of information on all the disclosures for a particular company. And then lastly, number 5, current events affecting the company. That would be C again, business periodicals. Anything going on current in the company would probably be published in a business periodical. Okay, and that is a conclusion to SE2 on page 617. Okay, so moving on to SE6 on page 618. We're going to look at doing a horizontal analysis on a company. If you follow along on page 617, we're going to be looking at the data for our company Otis Inc. And we've got the comparative income statements for the years 2011 and 2012 for Otis Inc. And we're going to look at computing the amount and percentage changes for the income statement, and then basically do a little summary comment below on whether we think the company's performance has gotten better or worse based on the increase or decrease in the component percentages of the company's year-over-year results. So if you reflect back on your notes for learning objective number 3 on horizontal analysis, we saw that in doing our horizontal analysis, we use this formula here. And if you think about it, this formula is really just like the percentage change formula we have done in our analysis in the past. So this is basically going to be your current year minus your last year over your last year times 100. That's basically what that formula is saying. So your amount of change over your base year times 100. So how would that look here? So basically we're just going to calculate the changes here in each one of these different components on our income statement. So if we take the change here between 2011 and 2012, we're going to have 70,000, 48,000, and this would be 22,000. And as a cross check, the difference here should also be the same as here. Okay, the difference in the changes here should be the same as the change here. 80,000 minus 60,000. And 54 minus 56 is a $2,000 increase. And you'll notice here I've reflected all of these as a positive number. If we had a change that was a decrease, we would reflect that in brackets. And then we have a $4,000 increase. And then here we do have a decrease. So we have a decrease of $2,000. And then income tax expense decreased by $2,000. And then the bottom line was no difference in their net income and no difference in their earnings per share. So we want to now do the calculation to calculate the percentage change. So if we would we can use this space down at the bottom of our page. And let's just look at doing the first one here, our net sales calculation here. So this is where we would take our current year, which is 360,000. I'm going to leave all the zeros off for argument's sake. 360 minus the 290 divided by the 290. So when we do that, we get the 70,000 over the 290. And that gives us, and then we multiply it by 100, pardon me. And that gives us a 24.1% change. So that's what we would put here, 24.1%. And then if we do the same thing for the second one, we've got the cost of goods sold. Is going to be the current year at 224 minus the last year divided by the last year equals our 48 over 176 times 100 equals 27.3%. I put that up here. So we're putting these up here. Sorry about that. I didn't show that off screen. Okay. And then we would keep doing the same type of calculation for all of these all the way down the line until we completed this grid, and we see that we have 19.3%, 33.3%, 3.7%, 40%, minus 4.5%, minus 12.5%, and then clearly here 0% and 0%. So it's nice that we can do all these calculations, but what we want to do is we want to really see how do these calculations, what do these calculations tell us about what's going on with the business in this past year. So when we look at this, we can kind of see a couple of different things. We see first of all that our sales went up by 24%, 24.1%, which of course is good. But on the downside here, some of their expense categories increased at a faster pace than their sales did. So we can see that the cost of their sales increased at 27%, while their sales increased at 24%. So what that may mean is that our company was not able to mark up its products to offset costs that were passed on to it during this current year. So in other words, their suppliers were charging them more money for things, but they couldn't pass that extra cost off to their customers. The customers maybe wouldn't purchase those items at that higher cost. Or maybe they didn't want to. Maybe they decided they didn't want to pass them off. Or maybe they changed the composition of their products. Maybe they're selling different products this year that they weren't selling last year, and they're trying to shift their focus for their business. Or maybe the market is down, and you know, the company couldn't charge any higher prices during the year. Maybe they had to sell things on sale more frequently because the market was down and people couldn't buy stuff as easily. In addition, we can see that their operating expenses went up more quickly, significantly. So their operating expenses increased 9 percentage points more than their sales increased. So clearly there's something going on here. That to me is not a good signal. You know, both their gross profit margin is a little bit weaker, and now we can see that their operating margin is also getting weaker. It's still going up, but it's not going up as a fast of a pace. Okay, and then we see that their interest expense went up really almost double what their sales increased. So that may indicate that they're borrowing more money during this year because maybe they're having a liquidity issue. So maybe they are having to borrow money to make sure that they can pay their suppliers, because they're not able to collect their receivables as quickly, and so therefore they're having to borrow a little bit more money to pay for things. Okay, so some not so good trends going on here. We might look at it and we might say, oh yay, their sales went up, and you know, they still had a good net income, and so on and so forth. But really, when you look at these percentages here, these percentages are not telling a good story about this particular year for this particular company. And that's the type of thing that I want you guys to be thinking about. Okay, we're going to stop there for this particular problem. Thanks, folks.